Stocks try to claw their way back after a Wednesday scare. Let's talk to George Cipolloni of Penn Mutual Asset Management, and I'm Lisa Bernhard with Reuters. George, Wall Street's volatility index spiked yesterday after the Fed signaled just 2 rate cuts in 2025. With valuations so high, are investors looking for a reason to sell?
So obviously, yesterday was a historic Fed day. Treasury moved up about 10 basis points, Treasury yields on the 10-year, and that was the most since 2013. Beyond that, we saw the VIX go up 74%, which was its second largest spike ever. And then so we saw across the board stocks react to that. Because I think the most important thing to show is that obviously, with regard to valuations, roughly half of the S&P's gain this year has been because PE multiples have gone higher. So what does that mean? That means that the market in general is going to be very sensitive to moves and expectations, whether it be Fed cut expectations or inflation expectations. So that move in the Treasury bond yield, it's basically saying that the Treasury market is in charge here. And so that valuation gap being higher is going to be very sensitive to up moves in yields. And that's what we saw yesterday. And that's the main reason why stocks went down.
So, tease out a little bit more why that 10-year Treasury yield is a risk for markets, and what else do you see as a risk for markets?
So the biggest risk, the reason why I see the Treasury yield going higher as a major risk for markets is pretty simple. So again, a big portion of the S&P's gain has been the valuation gain, and a lot of that has to do with, and if you think about all the excitement in the market that came post-election, the first 2 weeks post-election, the markets went wild, basically. Stocks did really, really well. Even value stocks did well. Let me give you one example. Banks went up about 6% in the 2 weeks after the election. But since everything changed, and the main reason is because inflation expectations changed. They went up a little more, and Fed cut expectations changed. So all these expectations of a nice, easy market, higher liquidity, all kind of stopped all at once. And that's what we saw yesterday. So now, if you look at it, there's been a big transition over the last week or so. Again, mainly going back to these higher inflation expectations. And we saw value stocks go back to their old ways of losing the growth stocks. We saw banks that were up initially about 6% post-election in the 2 weeks after. They're down about 12% now from a few weeks ago. And so again, I think the market is just at a very sensitive point. It wants liquidity, it wants low interest rates, and right now we're just not getting that.
You talk about growth stocks taking charge again. Let's look at Micron Technology, though. Those shares are down big today, despite the fact that it said its AI related chips, sales of those actually grew. So, what happened there?
Micron in particular is an interesting case because it kind of shows all the flavors of the market today. What it showed was that in certain areas, it's really, really strong. Its AI chips did really, really well, and they kind of fulfilled that growth promise there. But on the flip side, if you look at the products that they sell to phone companies and to the auto industry, it's both really slow. And we've seen that anecdotally from other companies as well. So the whole picture on a net basis, Micron lowered their sales guidance by a decent amount. It went from roughly 9 billion in terms of next year's expectation to the high sevens to $8 billion level, which is still pretty good. But again, the market just wants growth and it wants a positive story throughout. And our economy right now is not a consistently positive story. There are pockets of value, there are pockets of growth, but there are also some pockets of disappointment. And again, Micron's earnings pretty much showed that across the board.
So, as a value stocks guy, where are you seeing pockets of value?
I think the biggest area where we are seeing value is in certain, if you think about convertible bonds, look pretty cheap here relative to some other things. If you think about in terms of the stock market, there are huge gaps in valuations. Obviously, we talk about value versus growth all the time. And at a sector level, we are seeing that. Healthcare stocks, for example, are at historic lows relative to the S&P. Material stocks relative to the S&P are going down a lot. So on a sector level basis, there is value. The only thing is, though, and this is very important, each of these companies that you select here, they need to have some kind of growth potential to them. Otherwise, their PE will just stay down. And I think that was the trick for value investors, especially last year. If you just focus on the traditional value stocks and value sectors, you really didn't do so well because there was no growth. The growth was so concentrated. But if you look at small caps, maybe individual small caps, you can find some really nice growth stories to go along with low PEs. That traditionally has been an ideal place and a really good place to find value.